Recording in progress.
Hey, good evening.
Hey, how are you?
Hi, good evening, folks. Scott Rolfs with Ziegler and my
Let's
colleague.
try that again. Hey, good evening. Having some technical difficulties tonight. Sorry.
There we go. Scott Rolfs with Ziegler and my colleague Aaron Wade.
Thank y'all for joining us tonight. We're waiting on one more board member, so we'll give him a couple more minutes here.
Hey, Joseph.
Hey, Jamie. Just a minute here. All right, we'll go ahead and get started. Thank y'all. So I'll call the meeting to order at 7:02, and I'll read the mission statement tonight. Our mission is to inspire academic excellence, to nurture curiosity, creativity, and imagination, and to do so within an environment rich with warmth, kindness, and respect. All right, I will turn it over to Austin.
All righty. So we're going to start with a presentation from Ziegler, and Scott and Aaron already kind of introduced themselves, but maybe one more time for people that were not in the room. That would be great.
Absolutely. Thank you, Austin. I'm Scott Rolfs with Ziegler. We're a firm headquartered in Chicago. Been around for over 100. Firm's been around for over 100 years. I've been with the firm my entire career and specialize in providing financing to private K-12 and charter schools. And we work nationwide, done a lot of work in North Carolina. Excited to talk to you about some potential financing opportunities tonight. And I'm just going to turn it over to my colleague, Erin Waite, for a moment. She can introduce herself.
Thank you. Thanks for having us tonight. Erin Waite. I have also been with Ziegler my whole career. I just went over 24 years with Ziegler. I work hand in hand with Scott on all of our K-12 and charter financings, and it's nice to be here. Thank you.
So,
If
go
I
ahead.
could backtrack, I forgot something. Austin, you want to share with the rest of the board the good news you received today?
Yes, the Charter Schools Review Board voted on Monday for a 10-year renewal for us.
Great. Congratulations.
Yeah, that's fantastic. Austin, do you want us to start with the presentation? Is that
I do. Yeah, Rick is trying to log on. He's having a hard time. I'm not sure what's happening, but he's saying that he's having a hard time getting in. So, if you want to go ahead and start, and then we'll just, when he gets in, he'll get in.
okay?
That'd be great.
Let me just see if I can share screen here. I think I can. There we go. Make sure I have the right screen. All right. Okay. Does everybody have up this PowerPoint deck?
Yes.
I just want to make sure everybody's able to see it. So what Aaron and I would like to be able to go through with you tonight is a little bit of background on who we are at Ziegler, and then some financing solutions that we have for the school to consider for both refinancing the debt that you have and also possibly funding some new projects. I've had the pleasure of working with Austin and Rick kind of on and off here for the last 6 months. And I think it all sort of has led to tonight in being able to put this information together for you. This is an interactive presentation, so if anyone has questions at any time, just jump right in and we will answer them. But to get things going here, let me get things going. So goal, obviously, I think for your school, as we've talked with you, is you have some existing debt that could be potentially refinanced, refinanced long term, maybe at a better rate or good rate. And then also the need for some new construction and funding for that. And so what we're going to talk about tonight are some scenarios that are available through Ziegler to achieve those goals. One of the things I guess I want to ask the group is there anyone on the phone who has a strong familiarity with tax-exempt bond financing? Because I'm going to start kind of with a basic level, but I just want to kind of get a feel for if some of you have looked at this before or know, what this type of financing vehicle is. Okay. So if everybody can see the PowerPoint in front of them, What we do at Ziegler for our clients, we are not a commercial bank that takes in deposits and then lends them out like a commercial bank would do via that type of a loan. We are an investment banking firm that specializes in financing for K-12 charter schools. And how that we accomplish our financing is we have investors around the country. These are some of the larger mutual funds that you may have heard of, Vanguard, Invesco, et cetera. They will buy bonds for the projects that we underwrite. And the bonds that we underwrite for the schools that we work with are done on what's known as a tax-exempt basis, so that these bonds that they buy, that you issue and they buy, these folks who hold the bonds do not have to pay federal income tax on the interest income they receive, which is a really nice benefit for them. And that benefit can translate through to you in the form of lower interest costs on your loan and also some pretty neat features. With this type of structure, we can put together a true 35 or 40-year fixed rate financing. Now, you don't have to go out that long. We have clients that'll borrow on a 25 or a 30-year basis. But we just want to let you know that we can get a true 40-year, if you would choose, up to 40-year fixed rate financing. That is a true fixed rate. There's no renegotiations or interest rate resets you have to worry about at year 5 or whatever it might be. Interest rates still at attractive levels. We'll talk a little bit about that tonight. 100% financing. This, I think, is important for a number of schools. We do not have specific loan to value or equity requirements like a bank might have with a loan. And so we can finance 100% of your project or refinance, and we don't need to have you put in a certain amount of equity or to raise a certain amount of money as a down payment. We can finance 100% of the project. We'll talk a little bit tonight in some of the scenarios where we have interest only and capitalized interest options with the loans available. What that means is that we can set it up so you sort of ramp up payments to kind of grow into a loan as you may borrow for a new project. Additional bonds, this is a nice feature we have in all of the financings we put together. This allows you to do financing 1, 2, 3, 5, 10 years down the road for a phase 2 if you'd like to. And we don't need to refinance the first loan we might put out for you here in 2025. Last piece, century of experience with Ziegler. And we're just going to cover this real quick. We're a firm headquartered in Chicago, been around over 100 years. And we specialize in financing for what we call nonprofit community infrastructure, hospitals, retirement communities, schools, really anything that's community infrastructure. That's what we finance, and that's what we finance with tax-exempt bonds. This is a piece we put together, again, to give you an idea that we believe we can be a long-term partner with your school. We have pictured on this particular slide the very first financing Ziegler did back in 1913, and then a number of different schools that we've had the pleasure of working with here, again, over the past 112 years. These are just some of the schools that we have worked with recently on some different financings. And this is a charter school in California that we did some financing for a few months back. And again, Rick does have this slide deck. Austin, I don't know if he routed it to folks before the call or not.
Hey, Scott, I wasn't able to do that. Sorry.
Oh, all good, Rick. That's okay. I just want to let everybody know that after the call, Rick can route this slide deck to everybody, so you all have a hard copy to refer back to. This is a school in Sarasota, Florida, that we just closed an $18 million financing for. Again, this is about a couple months ago. And so we've been very involved in financing of schools of choice. Our average loan size right now is about 15 to 18 million, but we work with schools that borrow as low as 3.5 million to networks of charter schools that we might be doing a financing for them that could be 60, 80, 100 million. Interest rates. Just want to talk about this for a second. A lot of people are watching interest rates, and you may be doing it on a personal level. If you have a home mortgage, you have a car loan, whatever it might be. Interest rates have been sort of bouncing around in a range here for the last 6 months, but overall still attractive compared to the last 50 years. This graph is the U.S. government's 10-year Treasury bond, which is really the bellwether bond most lending rates are based off of. And this gives you an idea of where the yield was here over the last 50 years. And so everything has continued to come down. We had the COVID period, which was a bit of an anomaly, I think, where the Federal Reserve was trying to keep the economy going. Rates have moved up a little bit here than in the last few years, but I'd say they've more normalized. But I point this out to say that we're still lower than we've been significantly for most of the last 50 years. So it's not a bad time to borrow. This graph tracks flows, money flows into bond funds. So bond funds are the people who invest in the underwritings that we put together. And when we have inflows, which we've had the last few weeks, this is inflows, these are outflows, but when we get inflows, it generally is good for interest rates and for borrowers because it means money is looking for a home to invest in the tax-exempt bond market. Let's talk a little bit about your specifics now with your school. With tax-exempt bonds, and I'm going to cover a little bit of what I covered at the start, but the IRS has said you as a community organization, as a 501c3, a school, they like the fact that you are a community infrastructure piece. And so because of that, you are qualified to issue these tax-exempt bonds, just as a hospital might be, a retirement community, something that kind of contributes to the public good. The bonds in North Carolina typically are single tax exempt for the financings for the clients we work with. What that means is the investors who buy these, they do not have to pay federal income tax against any interest income they'd receive from the bonds they'd invest in. As I mentioned, we have 30 to 40-year fixed rate financing, and we'll show you a couple 35-year scenarios in a moment. And we can finance the entire amount of the project. There are some ongoing requirements you have with a bond issue, and we kind of want to go through the fine print here with you a little bit. Typically with these bond issues, we're going to put them out for, let's say, 35 years. The investors who hold these, they're going to want to know, they're going to be with you for 35 years potentially. They'd like to know that they have their investment for some period of time before you might pay it off. And so usually with this type of financing, there will be call protection, which means that you would not be able to refinance the loan for typically the lockout period can be from 5 to 7 years. And we negotiate that at closing. But in exchange for that, again, you end up with a long-term 35-year fixed rate. We have 2 loan covenants that the school needs to manage to each year. At the end of your fiscal year, when your audit is done, we ask you to run just 2 financial covenant tests. One is to make sure that you have at least 45 days cash on hand so that you have some operating capital to work with. And the other is that you are able to cover your mortgage payments or your debt service on the bonds at least a 1.1 times coverage. And we'll show you some examples of this on the next couple slides. Couple other things. With this type of bond issue, we do need to fund a debt service reserve fund. This is a rainy day fund. It's sized in the amount of 1 year's of mortgage payments. And it's in effect your money, but it's kept in an escrow account and used if for whatever reason you have some issues on payments in a given month or given year. It's sort of a cushion there. The other 2 things are we have a bond trustee. We work a lot in the Carolinas and North Carolina with US Bank, but there's others we work with. They're the servicing agent. That's who you make your monthly mortgage payments to. They in turn then will send out principal and interest payments to the bondholders. And then also we just need to be provided annual audits and then quarterly internal financials. So that's sort of the way the financial disclosure works. So that gives you just a basic overview on what a loan looks like from a covenant standpoint. These are just a few of the names that we work with where we place the bonds. And to give you an example, if we were to put together a $10 million financing, give or take, for your school, we probably would have in the deal anywhere from maybe 3 to 4 or 5 investors, similar to who you see here. And they might hold positions that would range from a low of $500,000 to maybe 5 million. But it's our job. We have these investors are our clients. We work with them every day. They like to buy the bonds that we underwrite. They know that we underwrite good schools. And so we have great relations with these folks. One of the things that we talked about with Austin and Rick a little bit earlier is what a bond rating is. Are people familiar with bond ratings? I mean, I'm going to discuss it. I just want to kind of get a feel. Anybody have a thought on bond ratings or knowledge? Okay. If not, I will go into just a little 30-second education on it. If you're a municipality that's going to be issuing tax-exempt bonds or issuing debt, you can go to one of the bond rating services, a Moody's or a Standard & Poor's that you may be familiar with. You can pay them a fee, and they will put a letter grade on your bond issue. And that letter grade will tell investors where they think the risk of the investment might be. And if you're someone like the state of Maryland, you have a AAA bond rating. So if I'm the state of Maryland and I'm issuing 100 million of bonds for a highway project, Standard & Poor's rates those bonds AAA, which means that state of Maryland pays a fairly low interest rate on those bonds. If you are the government of Argentina, a little bit different. Standard & Poor's rates those bonds as a triple C. Those are probably close to default. And you probably, if you invest in those bonds, you're going to get a pretty high double-digit interest rate return to compensate you for the risk. For most charter schools, if we were to get a rating, you're going to come somewhere in this triple B to double B category. Now, we would say and note for you that about 60% of the charter schools, 70% of the charter schools that issue bonds do not get a rating. They are underwritten by us at non-rated. And the reason for that is because the rating does cost money. A rating probably costs to pay Standard & Poor's probably about $50,000 up front and then about $6,000 a year. And we are able to get interest rates on these bonds comparable to where your rating would come in. And so our recommendation is if you decide to move forward with this type of financing with Ziegler, we would not suggest you get a rating. We can do a great job for you without the cost of a rating. Let me move to this slide. This is your school's historical profit and loss. And what we did is we took the numbers that we had from you over the last 4 years, 2021 through fiscal year 2024. Couple things that we got from this that are important for underwriting a loan for your school. First is what is available for debt service on a mortgage payment. So can everybody see this shaded row here, a line here, row here? Okay. What we calculate, this is called income available for debt service. And how we calculate this is we essentially say, let's take all your revenues, we'll subtract your operating expenses, and we will add back your depreciation and interest expense, or in effect, what you're paying on your loan now and any depreciation. And what you come up with is a number here that in the corporate world is called EBITDA, your earnings before interest, depreciation, amortization. What it really represents is it represents your free cash flow and is saying, how much money do we spin off that could go towards a mortgage or capital improvements or something like that? So the school has spun off on average about 650,000 a year of EBITDA, which for a school your size is pretty healthy. And so we can put together a financing for you with debt service coverage that again will be sufficient to get this financing accomplished. There's another metric down here that we calculated for you, and that is your days cash on hand. If you recall a moment ago, we talked about a loan covenant that would say that the school once a year at your audit end of fiscal year, we'd want to measure and make sure that you had at least 45 days cash on hand. In a sense, what days cash on hand represents is if all your revenue stopped coming in tomorrow, how long could you pay your expenses, your teachers, your insurance, etc., with the cash you have? How many days run rate would you have before you ran out of money? So the school has been very fiscally disciplined. You've had over $1 million of what we call the unrestricted cash. In your days cash on hand has been over 100 days. That's very healthy. And so you would not have any issues making that loan covenant. So Austin, Rick, I'm going to move on next to the proposal itself, the specifics of the payment. Okay. One last one and one last slide in here. This was the projections that we had gotten. And again, everything showed very good with your projections, very healthy, well-run school. Okay, this is the really kind of the whole show right here, so to speak. This is what a bond issue looks like in terms of loan size, payment, use of funds. And we're going to spend a little bit of time on this page. I know that the type is a bit small, but what we're going to do is walk you through what a bond issue looks like, what potential payments would look like for your school. And so we want to start up here in the upper left-hand corner and start with what we call source and use of funds. And so in the use of funds, what we have is, and I hope I've got this right, Rick, on the dollars you were talking, is refinancing about $4.9 million of current loan, and then a $4 million borrowing for new project. And we can change these numbers, post this call if you want to make the project a little higher, a little lower, or the refinance number may change a little bit. But what we're looking at is figuring out what under a tax-exempt bond issue would you need to do to accomplish financing that. Well, what you need to do is issue 10,090,000 of total bonds. And what that would cover is it would cover refinancing the note. It would cover the new project. It would cover funding 1 year's of debt service reserve, and I'll talk about that more in a moment. And then it would cover what we call cost of issuance. Now, cost of issuance is primarily the cost to get a conduit, tax-exempt government conduit, to issue the tax-exempt bonds on your behalf. We work with a number of them, and to do it, they charge some fees, and they have some attorneys involved on charging the fees. And so what it ends up being is it ends up that it's about a $300,000 plus number to get the conduit put together. And that amount is regardless of whether you're borrowing 5 million or 25 million. The other piece in this, and it's embedded in here, is our cost of issuance. And that's Ziegler's underwriting fee for putting the bond deal together. And we'll talk about that more in a moment. But over here, I want to just take you now for a second to this amortization schedule. On this amortization schedule, we have years going out 35 years, 2025 to 2060. So this represents a 35-year loan. We have principal payback that you would make every year. This is the amount of principal that you would pay down until eventually in the last year, you'd pay off the full 10,090,000. Note we have this set up with 3 years of interest only. In other words, you're not paying principal. Now we can run a scale for you that would show you paying principal in those first few years. But what it does is it gives you some breathing room to get the project constructed, add new enrollment, and again, kind of help you sort of grow into the loan. So it's an option that's out there. But as you can see, you start the principal repayments here. The interest rates, I'm going to talk to you about coupon and yield. These are different bond maturities that we will sell to investors. And so we'll sell some 10-year bonds. These investors will get a 5.25% yield if you buy a shorter term bond. We'll sell some 20-year bonds that would get a 5.5% yield. And then we'll sell some 35-year bonds where the investors who buy these, they would get a 5.75% tax exempt yield on their investment. The deal is set up though, the financing is set up though, so that you have level payments. And so there aren't balloons here. These investors are buying tranches and they will get paid off depending on which maturity they buy. Some will get called in between, if you buy a 10-year bond, some will get called in here in the first 10 years. This, though, is one of the key columns to look at. That's your debt service payments. Now, there's one other thing I'm going to come back to, which is the debt service reserve fund. We're having you borrow $687,000, which not optimal, but it's a requirement of the investors. And the reason we have this debt service reserve is in case in a given year, come August, your enrollment's lower than you thought, but you have some higher fixed costs you have to cover. You're under contract with your teachers. Or maybe the state hits a rough patch and cuts the funding a bit, or you don't have an increase, or you have some extraordinary expenses. The idea behind this is a rainy day fund you can draw on to make sure you're current on the loan payments. While you're borrowing for this, it also is your money. And so this bond issue will have this debt service reserve fund be in an interest earning account, and you will be able to earn a market rate of return on it. And then when you would pay off the bonds in year 35, or if you paid them off sooner, that full debt service reserve fund gets credited towards the payoff. So that it's not as if you're borrowing money and it's some sort of a fee. You're actually borrowing it sort of be a rainy day fund for yourself. You earn interest on it, and then it's credited towards your payoff. Questions on that concept?
So I note you have, refinancing of outstanding notes. Is it a requirement that we have to refinance all of the outstanding notes?
It is. We've talked this through. We know you have some different notes that may be at some favorable terms. The situation though is for us to get the financing accomplished, we do need to have a first mortgage on the property. And our understanding is the current notes you have are secured by the land and buildings.
Okay.
I'm going to go over here again to the net debt service column for just a second and show you here what your payments look like under this scenario. So because we have interest only here for the first 3 years, your payments would be about $576,000 a year. And then in year 4, this is where principal payments would kick in, and the payments would jump up to about $685,000 a year, and they'd be level all the way out for years 4 through 35. One question we do get asked sometimes is, you're telling me the payments are level, but each of these payment annual amounts is $1,000, $2,000 difference. The reason it's not exact to a penny is because the bonds are sold in $5,000 denominations. And so every year you're paying off principal in an even $5,000 multiple amount. But essentially, given the size of the loan, the size of your organization, this is level fixed payment. One thing to remember here also is these payments cannot and will not change regardless of where interest rates go. So if interest rates go up 2 points a year from now, or 3 years from now, or 5 years from now, your interest rates stay the same. And your blended rate right now is about a 5.70%. That's what we call the arbitrage yield. That's sort of what the IRS looks at as the rate on the bonds when you combine these different tranches. There's one point I didn't bring up. I'll throw it in now. Some of the bonds are not eligible to be able to be finance tax exempt. And this is pretty common that we have certain issuance costs that are not eligible to be finance tax exempt. So we finance this with a taxable bond, and the taxable bond typically in the current market would have about a 7% yield on it, but it would be paid off very quickly here in the first couple years. And so it doesn't have much of an impact on your overall interest rate, but we wanted to explain it so that we understand, you know why we have this little taxable bond piece up here. Let me just pause for a second for questions on this particular scenario. Robin, do you have a question?
No.
Okay. One thing to note is we only have one scale in this deck tonight. This was a result of, again, talking with Austin and talking with Rick here. We can run different scenarios for you that might have a little bit higher or lower project size, little different payoff. We can run a 40-year scenario or a 30-year scenario for you if you'd like. And we could also run a straight line. I would note, though, that for clients similar to yourself, for us with the firm, I would say 80% of our clients right now are taking the 35-year option, and most are taking advantage of the 3 years of interest only to allow them to, again, grow their enrollment a little bit with some new buildings that would be built. So questions
Rick?
on this? Go ahead.
I was just to say to Rick, I don't know if you already have it or not, but before we make a final decision, I would like to see a 30-year, just for comparison.
Okay. And Joseph, one thing I thought of, and Scott, on the, where you refinancing existing loans. So there are instances like two of our loans are USDA based. And sometimes if USDA would say, well, we'd have to remain in first position. So if you bring in a new lender, they've got to subordinate. And that's something that can happen with USDA when you try to bring in another financing agency. They'll ask for that agency to subordinate behind USDA.
Just a couple other pieces just before we leave this. We can run different scales and options for you and different numbers. But again, I think the whole structure of a tax-exempt bond issue, the appeal of it is that we can lock something in for you for 35 years, and we take all the interest rate risk off the table. It's not like you're borrowing from the bank where maybe in year 3 or 5 you have to get an interest rate reset. The other couple pieces we note is we can finance 100%. We don't have any issues with loan to value, or we wouldn't need you to raise an equity contribution of cash to go into the project. We can finance it all. And this has just been a very popular way for charter schools to obtain financing. I have a next slide here on timing, and this is looking at how long it would take us to put together a financing. Generally, we can have everything closed start to finish in about 75 days. The only thing that really drives timing would be with your project. You're obviously going to need to get a construction contract or contracts and get appropriate municipal sign-offs, building permit, if you have a DOT sign-off you need, or a traffic study. So what we normally do with clients that have a building project involved is we do all this underwriting to about week 7, and then everything's ready to go for us to take the bonds out, lock rates, close the deal. But we generally will pause here and wait until you have your approvals and your construction contract in place. And the reason we do that is we don't want to finance a project dollar amount where we either underfund it or overfund it. And as you know, until the contractor actually gives you a fixed price contract, you don't really know what that cost will be. And same thing for municipal approvals. Until the DOT and everybody looks at your building plans and says, yeah, this all works, you just don't know. They may require you to put in a certain fire hydrant somewhere or whatever it might be. So that's really the key. But that said, everything stacks up very well for us to be able to get something accomplished for you, again, 75 to 90 days. The last part of this slide deck is just things you can go through when Rick routes it around. It's just biographies, experience of us on the Ziegler team. We have a bunch of different references that you can reach out to, talk with. Overall, though, we've done a good look at your school. You have a great operation. We feel very confident that you can safely borrow this amount, and we can underwrite it if so engaged. We'd love to earn your business.
All right, thanks, Scott. Really appreciate it. And just for the board, in your folder for this evening, the slide deck that's in there it's Scott, it's your update you sent around the middle of January, just before our January meeting. So, so this slide deck is fairly the same, except for just some of the updates on the bond rates on one of the slides. The bond rates being as of February 7th, for example. So, but I'll put the other slide deck in your folder for the board.
Thank you.
Absolutely. John, how are you?
Good, doing well, Scott.
All right. We know John. We've worked with him in the past.
On a Montessori school transaction too.
There you go. So, all right. Anything else we can provide you with tonight in the way of questions or information?
I just want to say, on behalf of the board, thank you for your time. And I know this is after hours. We greatly appreciate it. And it's a big decision for our small school and community, but we don't take your time for granted. So just appreciate that.
Fantastic. All right.
Thanks, Scott. Appreciate
Thank you.
Good. We will sign off. Thank you. Yep.
Take
Bye-bye.
care. Have a good evening. Okay. All right. And right out, the timing worked out great. So I had I had John Fan come in. I told him about 7:40, so the timing was really, really perfect. So just for the board, so wanted basically this to be twofold tonight. One, Scott's presentation from Ziegler, but also it was kind of recommended that it was very important for us to have a municipal advisor, and so I got connected with John a few weeks ago. Had a Zoom call with him, and the reason obviously is that in the relationship of this is that Ziegler basically very good company. But what they do is they put the bond underwriting together, but their fiduciary responsibility is to the bond holders, the investors, right? And so this is just it's important for the school, for you all as a board to consider going through this, not only for the underwriting, but for the long term, is to have a municipal advisor whose fiduciary responsibility would be to the school. And so, having said that, I'll bring you in, John, to go ahead and start your presentation to the board. And we thank you very much for your time this evening after hours. But so it's your turn to go ahead and present. Okay.
Great. Thank you. Thank you again, Rick. I appreciate the opportunity to present to the board president and the board and the executive team. My name is John Pham from Campanile Group. We are municipal advisors, like what Rick said, and our duty is to help negotiate the best terms and the most flexible, the lowest interest rate for you on a fiduciary basis. And on a $10 million transaction, or however large this transaction is, every basis point counts, right? Because 0.01%, 0.10%, 0.10%, that goes down to the bottom line. And in the charter school world, the credit is not like a typical mortgage where it's pegged to a certain index. You're negotiating with investors, sophisticated investors, and what Rick said, the underwriter's job is not fiduciary to you, right? And the SEC created this role called municipal advisors, where we negotiate on your behalf and protect you. And not just the interest rates, we're also talking about financial covenants, and there's many nuances to financial covenants, and there's also reporting requirements, annual, quarter reports, that you have to provide, and we negotiate that for on your behalf. The past 10 years, I've done over 80 charter school transactions, a lot of them in North Carolina. I'm working with the largest CMO in North Carolina right now, Trinidad Math and Science Academy, on a $95 million transaction. I'm working with some other schools, Achievement Academy, Wayne STEM Academy. I completed Cornerstone Academy in Greensboro, I think in October last year. I worked at Guilford Prep like 2 years ago, but many more, especially nationally, done 40 or so in the past 5 years or so. So, this is what I do. I do this every single day. We're fully registered with the SEC, fully compliant with the SEC. We get audited by the SEC and fully compliant with them. I'm also a founding board president of a school in California. So thank you. I know how much work it takes. So I know what you guys are going through. In another point that I want to make too is that, in a financing, it's just not just municipal advisor and underwriter. There's actually many parties. There's bond counsel, borrowers counsel, trustees counsel, issuers counsel. So there's like a big party. So as your municipal advisor, I will help negotiate those fees as well. Let me think of any other things I wanted to cover.
Hey, John, can you talk a little bit about the post-issuance
Yes.
compliance? I really wanted the board to have an understanding of those things, which and all the way out to annual meetings with the bondholders. I mean, those.
No, yes,
We
definitely.
can talk through those.
So this is a security. So what does that mean? What does security mean? It means it's security is unlike a loan with a bank, in that you have to provide full disclosure, not only initially, every information, all material facts about the school and the terms of the issue. You also have to do it on a continuing basis. And the reason why is because securities, just like a stock, gets traded, right? They get traded to one investor to another. So investors require, when you do a bond, that you provide quarterly information, annual information, and have investor calls. And our firm, on all of our transactions, we help with that as well. We help you comply with your quarterly reporting, your annual reporting, and that includes, obviously, a lot of this information is about school, right? We're trying to gather information like enrollment information, academic information. So you're going to be producing a lot of this, but certain things like, calculating your financial covenants. We're the ones that are drafting and helping you draft those financial covenants and making it flexible and knowing all the key terms. So we would draft those financial covenants for you. And in terms of an annual investor call, we will host an investor call for you. We will provide an agenda. We'll coach you on what the topics are for the annual investor call, and guide you throughout that process. And we're there as a resource pretty much the entire time. Obviously, the bonds will be very long, but it will be there. I hope to retire in 20 years or so. So maybe not be 30 years, but 20 years.
For the board, any questions with what John has talked about briefly? Is it, like I said, it's a very brief overview, but it's for the board. Like I said, it's something I think we definitely need to not just consider, but from my standpoint, as the finance officer, we're going to go through this. I think we have to.
Yeah.
We have to have a fiduciary. I mean, that's but from my standpoint, if you I really think about not just the underwriting, but really all the post underwriting compliance, as particularly over a long period of time, and just for what to make that point.
Yeah, and to add to that too, in the tax exempt market, there's municipal advisors pretty much on every transaction. In the charter school world, which is also in the tax net market, it's not as well known just because charter schools don't issue as often. So you as a board, as an executive director and finance CFO don't know that they're people like us, but cities and municipalities, universities, all those transactions have a municipal advisor, a fiduciary looking at them, looking out for them. I mean,
Any questions from the board?
and I did give Rick some references, Cornerstone, one, I believe, and I believe TMSA is the other, Rick, for you to check.
Yeah. Okay. I gotta unmute myself. So I think we're good, John. So I knew I was gonna do it, Joseph. They're gonna hit the
All good.
I knew it was gonna happen. No, we appreciate your time, John, and after hours. So we'll be back in touch, okay?
Appreciate. Thank you for the opportunity.
All
Thank
right.
you, John.
Have a good evening. Take care.
Thank you. Thank you.
All right, so just for the board, so really the primary focus tonight was twofold. Presentation from Ziegler, and looking at a profile of financing as we've talked about briefly in the last two board meetings. All with the intent to financial pathway to basically replace Children's House, Building 4, as we've talked about, kind of going back to 2018 when I think the project was quoted, but it was in alignment with the middle school. So looking at having a bond-based financing as opposed to private bank, that was the focus there. We did when Austin and I went to the Charter School Coalition Summit meeting in Raleigh last week, and one of the speakers was a gentleman who had been a district finance officer for years, I think, over in Durham, and basically has since he moved on from there, and he's really been focused on charter schools. And one of the things he said on Thursday was that kind of the lay of the land with public charter schools is, as we all know, public charter schools have to finance their own way when it comes to buildings. And but the primary path has always been bond-based funding. That was the note I took last Thursday for a long time, over 20 years. So public charters primarily do use bond-based funding in this regard, as opposed to bank funding. Some charter schools do have USDA loans, and he was the one that made the point about when you bring in, and it kind of goes back to Ziegler's proposal, where if we go this route, we refinance our existing long-term debt on lower and upper L, middle school, high school, and then lower and upper L, those are USDA loans, and so USDA does routinely have a requirement where if you bring another lender in, that other lender has to subordinate, and I don't think that's primarily why Ziegler requires the whole package, but you kind of get the point in relation to USDA loans. And then we basically asked Scott to increase the new project amount for the purpose of this presentation to you all to 4 million. When we initially got the quote from Stocks and Taylor, just to refresh everybody, back in 2000, and I think it was 18. It was actually about 2.5 million. That was a dual quote, the new Children's House and middle school. And so given consideration, number one, of time and higher cost of things. Now we don't have a fixed quote, but Austin and I figured, well, I think we started with 3 million, so let's just take that up to 4 million, so you all could see if in reality it is 4 million, could be less, you know, what the debt servicing would be over 35 years as Scott presented. So, and then the other side of it was, again, it came to me, from another agency we did initially work with on charter school financing. Very strongly, he called me, made a very strong recommendation that, you know, we have a municipal advisor, and that goes to that fiduciary relationship. And because Capital Group, their fiduciary responsibility, like I said, is to the bondholders. And a municipal advisor that would be a fiduciary directly to the school. So it's a lot to take in, obviously, and this is not a decision point, but really to have it in focus. These two gentlemen talk to you all tonight, and then we can basically you know, proceed from there. To your point, Joseph, I can have Scott do a 30 and a 40 year, so you can see 30, 35, 40. And I'll just see if any questions. I kind of I could probably talk more on this, but only because I like talking about it. But anyway, any questions up at this point?
One other thing I was going to ask if you or Austin could just briefly touch on. I forwarded out the document, Austin, that you sent from Stocks and Taylor to the rest of the board. If you just spend a couple minutes hitting that at a high level of what that is. And
Yes, essentially, when we met with Stocks and Taylor, and basically what they did was the document you see, Joseph, is basically I call it a preliminary, I'll call it a sketch. So we basically sat down and we said, hey, and what we did was there's a little bit of deviation from the first plan, and that being when we had them over on the property and we were kind of looking at the children's house and building 4, what used to be the old middle school. We kind of started to see that if we were to basically tear down and replace children's house on where it sits right now, that part of the property has become a little bit confined in the back, because when we built the high school and middle school, we basically, that runoff area of water comes down behind, it's kind of on one side of the soccer field, comes down behind children's house. And so it kind of became clear to us that, hey, the area where building 4 sits, that land area, or that part of the acreage right there, is actually fairly sufficient. It's probably a better place. So we got to the point where when we got with Stocks and Taylor, said, well, because the whole idea with the original modernization of Children's House was to combine all the functions that were in Building 4 or the old middle school. So we got to a point with Stocks and Taylor where, hey, let's sketch out a plan with one building being over there that would have both Children's House and a building to support all the what comes out of Building 4, right? So we met with them, gave them the number of classrooms we would need in Children's House, the number of student service support spaces we would need, and then they came up with, his architect came over and kind of walked through Children's House and Building 4. And so basically they came up on the sketch, Joseph, with about 12,000 square feet that you see on that document, right? Given what we basically talked to them about, and that was me, Austin, and Jody Anderson, and so that's that part of it. And so this project would require the other part that's in that document. If we proceed forward, then basically we would have a new sketch, what I call new architectural plans, right? Because we basically have a different building design, right? And so I think Selden projected that there would be a cost there. In that, I think it was about $216,000, which if you think of the project cost, we got 4 million that we asked Scott Rolfe to do. You know, that component would be in there, as well as the demolition of the building, which Selden is aware of, but we don't, so we would have to get, that's basically the gist of that document there. And I think Selden mentioned, and it's just it's really a soft projection. I think he talks about 300 a square foot. That's really a soft projection. That's not a fixed projection. And and uh, and so did I cover all the points in that document, Austin? I'm looking from recall. I think those are the main points. If
Hey,
Joseph,
Rick,
if you're looking at it, if I missed something, just let me
I have
know.
a question. Does the demolition, was that included in that? The two buildings? It wasn't. Okay.
Yeah.
Well, and one of the things that, so I asked him about that, and one of the things that he said was they can certainly do the demolition, but he said there may be somebody else that could use the buildings, so we could almost like move them off. But I mean, the only one we're going to demolish first will be building 4. So that one will happen, and then down the road, the children's house building. So it just kind of depends. I don't know that anybody's going to want that building, to tell you the truth.
Yeah, I think, and Sarah, this might be where you're going, but I think we just need to make sure that we have the cost captured. I kind of view this, we've got one opportunity to secure funding for this.
Yeah.
Yeah.
And so I think within that, if we can sell the building or even give it away and somebody can get use out of it and they're willing to move it, that's great. But
Mhm.
we need to be prepared for worst case scenario if we're responsible for demoing the building. Because
Yeah.
at the end of this, we want to have a nice, pretty, and sustainable facility that we can have without having to worry about this.
Yeah. I'm just looking at the job Selden real quick.
And did they give? I'm looking here at the schedule. I don't see anything that talks about what they're estimated. I guess it does say operational by August of 2026.
Yeah.
Right.
Yeah,
And
and that's assuming we executed already, probably.
Yeah, we just I said, okay, let's start there, August of 2026, right? And then then the question was if we started there and kind of came back to February, the month that we're in.
Well, I think it's a realistic, and you tell me if I'm wrong, but I think it's a realistic goal. If you know, I feel confident we'll make a decision one way or the other the first half of this year, which would still put us on track
Right.
to have something completed before the end of next year.
Right. And the other thing that I want the board to look at is the updated the 5-year plan. So that's in your folder for you on the board. And the 5-year budget, I should updated 5-year budget. So, look through those numbers really carefully. I mean, not when you look at that, because I tabbed it out for each year, starting with the current year. Uh, Very similar to what you've already seen in any budget, funding side, the expense side. But I also tabbed out the projected enrollment, which lines up, of course, with what our strategy is with enrollment over the next 4 or 5 years. And because that aligns with our state funding, right? And and so, but and then any points in there, because that's basically what Scott drew off, as well as our audits, to uh, do their evaluation, which he pointed out in the brief of, um, do we meet, are we healthy financially, and do we meet the debt to service ratio, which at a minimum is 1.0, and we're over that. Do we meet the uh, days cash on hand, which is 45 days at a minimum, and we average over 100. So, keep those parts of the slide that are already in your folder, and I'll add the updated one. take a look at those numbers again in relation to the 5-year budget, particularly the coming 4 years, 25, 26, all the way out to 28, 29. And I think it's important for the board, not just strictly from the numbers, but it's really looking at it from the operational objectives that the school has, which goes to not just simply sustain enrollment, but uh, really being at full capacity across all the levels, right, in a sustained way. You've heard me talk about it quite a bit over the past year or so, and that's looking at what we've invested in the existing buildings, as well as this one. And because you're really looking at, if it all works out, from the facilities or a building standpoint, our oldest building would be 18 years old. And that's either lower L or upper L. Everything else would be younger than that on a 35-year profile. And so I think it's important. But and then the other part of it is just you know um, anything that comes to mind from you all as the board, you know, financially, put it together, whatever you need. If you want more in depth on days cash on hand internally, in relation to those 5-year budgets, a little bit more in depth, just let me know.
Yeah, if you wouldn't mind, Austin, if you can send everybody, and not to sign you up for a bunch of work, but if you could just send us a consolidated email with a copy of that 5-year report, the Stocks and Taylor document that we just talked about, and then also a copy of the presentation tonight. And then my ask to the rest of the board would be, just to continue to review that and consider everything we've heard tonight. I'm not saying we'll make a decision next week, but we can definitely continue this conversation and see where things go, if we are to that point, or any follow-up questions that everybody has over the course of the next week as you dig through those documents.
Yeah, and let me reach out to Selden and see what a potential cost for demolition would be. I have no idea. So just so we have that, and I'll think on, and maybe he can give me a little guidance, I guess, on what it looks like to move a building like that.
And then I'm assuming the $216,000 that we would pay Stocks and Taylor for this additional fee, we would pay that after we secured our funding, Rick? Is that right?
And that's something I want to follow up with Sheldon as well, because that's the only question in mind. Does he need that up front? Can we get it? I know that, to me, it would embed in that project cost, Joseph,
Yeah.
right? But the timing of it, we'll verify that with Sheldon.
Yeah, that's definitely what my question will be. I mean, if we get to that point, can we, a notice to proceed or whatever he needs, that, hey, we're going to move forward, but we'd prefer to make that payment once we've secured our funding.
Yeah, okay. And if it is up front, then I'll come back to the board with some recommendations, how to do that, basically in terms of sequence, right? And the sequence would simply be not really, yeah, simply, if we had to pay it up front, we'd well, we'll talk about that, because we just have to have reasonable assurance that the underwriting would be clean and successful, because that's where we would recapture it back, right? Once we did secure the total bond funding. But we'll talk to Sullivan about that.
The last point I had, and this was, part of the 30-year versus 35 or 40, Rick and Austin, just for y'all to think about and just be interested in your input as you, kind of mull this around. But with our buildings right now being 18 years old, and that's going to be lumped into this bond, even at 30 years, the easy math on that's 53-year-old building at the end of this. Now, none of us will probably still be involved at that point. But just kind of thinking about the future and what position we're putting the school in when those days and as these buildings continue to age.
Right.
So, don't expect anything right this second, but just something to think about, we consider. as we move forward.
Well, I mean, it's right on point, Joseph. I mean, like any school, the age of your buildings, it comes down to, and we'll put that together. And what I'll do is we'll put it together this way, if you're okay with Joseph and the board. So, looking at, because what you're kind of touching on, yeah, it's 18-year-old building, add 30. So that's, at the end of this, that building, what's the age of it, right? So, so part of that backdrop that I'll give you is, over a 5 to 10 year period of time, I'll kind of profile what upfitting the two oldest buildings would look like over about a 10 or 15-year period of time, not as a function of the project costs, right? But as a function of a school plan, a maintenance plan, right? Which is not just simply fixing the plumbing, but hey, at what points in time would we need to consider, meaning the school, whoever's on the board at that time, and this is what we needed to put in, like I've talked to you about on the overall school maintenance. This is why we have to have a maintenance plan that goes out 5 to 10 years, because regardless of financing, it takes into consideration at what points in time do your oldest buildings need to be in either like a phased upfit. You could do 3 phases, what over 3. So I'll kind of sketch that out for the board too. So it's not just simply, hey, we're going to have like a 35-year obligation here. By the time you get to the end of that road, and right, it'll be all different people, right? I think it's important for all of us to be on the same page, to have in concert, a maintenance plan for all of the buildings, lower, upper L, first and foremost, because they would be the oldest to start with. But then, because the high school building's almost 10 years old, 11 years old, right? So I just want to share that. I think we'll kind of have that sketch available to you, just kind of maybe in an outline format. Maybe not next week, but by the March meeting, I'll say, hey, this is what this would look like. So you all know in parallel how this would all fit in, if I'm making sense right now, I'm talking about.
Yeah, I'm following you. That's awesome.
Okay.
Anybody else on the board have any questions right now? Errol, this has been a lot of information. It's been very helpful for me, I know, and definitely appreciate all the efforts and all the work y'all put in up to this point. But anybody else got any questions right now?
I don't have anything.
Okay. Austin, anything else from you before we adjourn?
I don't think so.
All right. Well, just a reminder, we'll have our regular meeting next Thursday at 7. So looking forward to seeing everybody. But if nobody has anything else, at 8:10, I'll entertain a motion to adjourn.
I'll second that.
Got Robin on the second.
I'll first.
Okay. Thank you, Sarah. All in favor?
Aye.
Aye.
All right. Thank y'all, everybody. Have a good night.
All right, thanks, Joseph.
You too. Bye bye.
Bye-bye.
See y'all.